Hi, I wanted to touch base on the market drop. This is Curtis Chambers, and a lot of people, a lot of investors are very concerned about this decline. What I wanted to really talk about in this video is that, like the Tom Jones song from 1965, it's not unusual for the market to drop. And so, if you've been nervous watching the market lately, you're not alone. Many people are. But this is a reminder, this type of decline is completely normal. And in this video, I'll walk you through how often markets decline, how fast markets decline, and why staying invested is usually your best move. So first, let's talk about why market declines are normal. And pullbacks can be thought of as part of the price that we're going to pay for having growth investments in a portfolio. 5% declines in the market happen quite often, on average about 3 times per year. And that's even in good years. 10% corrections occur about once per year, and that's statistically normal. 20% bear markets are more rare. They occur about every 4 to 5 years, probably closer to 5 years on average. So the market might feel bumpy right now, but when I look at the data statistically, this looks like a normal expected occurrence. And it's been a long time that we've gone without a drop in the market, and so that can make it even more disconcerting when we have one. So the next thing I'd like to talk about is that market declines happen fast. This year in March, the market went from an all-time high in about 3 weeks to a 10% correction. That's obviously scary. But it's not unusual. Remember COVID, the market went down 34% in just 33 days. And in 1987, I had just gotten out of business school in St. Louis. The market went down 22% in one day. So that's why I like to say that the market takes the stairs up, but the elevator down. On average, a correction, which is a 10% decline in the market, reaches a bottom in about 4 months. Bear markets, which are a 20% decline, usually bottom within a year. But because these declines are so fast and so speedy, they happen before anyone has time to react. So trying to get out in time, usually it's too late. But that's okay, because what's important is staying invested, and it really matters. So markets recover. They always have, but only for those investors who stay in. Since 1980, the S&P has been positive 74% of the time during 1-year periods, and up to 85% of the time for 3-year periods. So what that means is, the longer you stay invested, the more your odds improve. Now, missing the best days of the market is one of the best ways to harm investors' returns. So, for the period of 1990 through 2024, if someone stayed fully invested, they would earn 9.8% annual return. But if they missed just the one best day of the year, each year, their return would have dropped to 6.1%. And if they had missed just the 2 best days of the year each year, their return would have dropped to just 3%. What's more, those best days often happen after the worst days. So we can say the market takes an elevator down, but after a market correction or market decline, it often takes an elevator back up. So you don't want to be on the sidelines when the market rebounds. And this is why we don't want to react too much when the market goes down. We want to stay focused, stay steady, and stick to the plan, or as my son says, we want to lock in. Market declines like the one we're experiencing, completely normal. Now, this doesn't mean I'm predicting that we'll quickly recover. We may, or the market could go lower. We don't know. But what I can say is that statistically, what we're experiencing right now, in spite of all the media discussion of why it might be occurring, but statistically what is occurring is normal. It's not unusual. And like the song says, it's not unusual. So what we want to remember for long-term investors is that this is all part of the journey. It's part of the process. So stick to the strategy. Avoid quick decisions and stay invested. Please like this video, and if you have a friend who's concerned about the market, share it with them. Maybe it can help. Subscribe for more updates, market insights, and financial strategies.